The Asian markets, which have moved lower after opening in the green.
Up 0.2%, exactly as expected.
All reports of stake sales by the promoters are speculative.
The market is stalled around this 19,630, 19,645 zone. You need to kind of cross this.
This is a very large deal by HCL Tech, $2.1 billion.
Astral expect flows of close to $176 million.
It is HCL Tech's largest services deal.
The Bank Nifty is the one, remember, that's been dragging its feet a bit, and that is once again opens with a cut of about 67 odd points.
We could see still about 15-17% kind of earnings growth for the year.
So the company has lowered its domestic business growth guidance.
The Nifty Pharma Index is down more than about 0.5%.
We believe the first draft is now ready.
We are in fact conducting our internal inquiry and we will look into it.
If you observe actually last quarter of 23, there was a tremendous pressure.
Okay, that is the day so far. You're with us here on a fresh new edition of Closing Bell, the last hour of trade coming up. There are three of us here, but actually not three, but four, because you can't see. We'll move the camera a little bit. Prakash Diwan is with us as well here in our studios. But I'm Prashant. With me, my colleagues Rima, Surupi, and of course, Nigel is joining us from the newsroom floor as always. Guys, hi, good afternoon.
And let's say hi to Prakash. He's now visible on the screen.
Hello, Prakash. Good to have you in the studio.
Hi, it's lovely to be here, but yeah, thanks.
So yeah, good to have you here, Prakash. Well, I just quickly take a look at what the market is doing, and then we'll kind of look at specific stocks, etc. So we broke below Wednesday's low. This was the first kind of support, or whatever you want to call it, a marker on the way lower, which was 19,467. And at least intraday, we've broken below it. We're just above it now. The close, in that sense, becomes important. The banks are particularly weak. Yesterday, there was the index which lost more than what the Nifty lost. It's making lower lows very clearly. And the Nifty Bank also, at least on an intraday basis, has broken below the 3rd of August low, which is the recent low in the cycle, which was 44,280. Again, the Nifty Bank is just above that level as we speak. So a close again here should be interesting, important. Market breadth is almost 1:1, a little bit tilted in favor of declines. Small cap index is still a little bit higher, and that's been the incredible part of the market, which just refuses to give back gains. Mid caps are down, but nothing on the small caps, which is still trading with a little bit of gains. Lots of stock specific action, both up and down, and that's the focus here over the next 60 minutes. Rima.
The space which is very excited are the mid-cap banks. So IOB, Central Bank, J&K Bank, UCO Bank, Bank of Maharashtra. Across the board, you're seeing some very, very large gains in that. That's the mid-cap banking space. Keep your eye on India Cement. Now, India Cement has been moving up for the 3rd consecutive day and on very large volumes. Today as well, India Cement is up close to about 6.5%, and a one-week chart of that would be quite helpful to show you the kind of gains that's seen. On the earnings front, there have been a few disappointments. So Alkem struggles for the second day in a row. The company has cut its India domestic business revenue guidance. Apollo Tyres, mixed set of numbers, but the stock has taken a bit of a beating. And now even some more defense numbers are out. I think BEML just came out with numbers a while back, and that stock is slipping in trade. BEML has a loss of 75 crore in the current quarter.
Yeah, that's a result reaction that's not really gone too well with the street. But Prashant, I completely take your point. I think, as much as we want to have big, bright smiles on our face because it is Friday and we will by the end of this hour, the fact is it's been a weak market. And if we have a close at the weakest point of the week, then that's never reassuring, right? The other thing that I was looking at was the Bank Nifty, which has been a consistent underperformer. Now, if you look at it from the top of the rally, the Nifty has lost about 2.5%, which is actually not too much. I mean, we feel a little somber when we're looking at this red screen and, 19,450 thereabouts on the Nifty. But it's just 2.5% from the top. The Bank Nifty has lost 4.5% from the top. And throughout this earnings season, if there's been one thing that's constant, it's the underperformance of large banks. PSU banks are a different story altogether. As Rima pointed out today, different factors over there. Perhaps just some interesting trading action going on. But the large banks, your big blue chip banks, they have been underperforming. However, as I said, it is Friday. So I do want to, toss to Nigel on an optimistic note. So look at some of the action in the mid-cap space. Not only is the mid-cap index outperforming the benchmarks, Look at names. Genus Power. Remember, smart metering is such a big theme in this market. So Genus Power, again, is up 10%. It's seeing some very smart buying today. Force Motors numbers were very good. The stock's putting on another 10%. It was up yesterday, I think 10, 11% yesterday, another 10% today. And then you have the likes of Kalyan Jewelers sparkling away with a 12% up move. Some more movers and shakers on the upside in the broader market. Nigel, what say? It is Friday. We have reason to be cheerful, right?
Absolutely. A lot of reason to be cheerful. And Friday, I'm really looking forward to this weekend. And then we have a truncated week ahead as well, Surabhi, so it only gets better from here. But in terms of the market action, I would say it's not too bad. The 19,425 odd mark has held out. And we have bounced 50 points from there. So that's pretty good news, I would say. And this 60-point cut, 70-point cut, we saw it in the first 15 minutes itself, first 15 to 20 minutes odd. So from there, though we did see a bit of a winding of this cut, but we haven't fallen apart. And the Nifty bank as well, it's holding on to the 44,300 mark. I'll tell you what, it's at a very, very crucial juncture. Because if it breaks this, then it slides down to around the 100 DMA. So you don't want that to happen because that's an 800-point slide from these levels. The Nifty bank, that's the weak pocket. And despite that, the Nifty is holding on. So not so bad, but the final 60 minutes will be crucial. And you don't want the markets to end at the low point of the day. But to find out how is the technical setup and how do you approach trade, we're joined by Nagaraj Sethi, the Senior Technical Research Analyst at HDFC Securities. Hi Nagaraj, good afternoon. Thanks so much for joining in. What's your view on the index? The Nifty bank, well, that's a sore point. But on the Nifty, how would you trade it?
Hi, good afternoon. Nifty has been in a downward correction over the last many weeks. On the daily chart, what we can observe is the lower tops and lower bottoms. And after the formation of the lower bottom recently around 19,645, Nifty has been resilient to show any sharp decline from here. I'm expecting, even though market is showing a downward correction, so I'm not expecting any bigger decline in the market. From below here, 19,300 is going to be a strong support, and further weakness from here is expected to be 19,100 to 19,000 level, which is a strong support for the market. And I'm expecting a good amount of upside bounce from here. From a chart angle, from the long-term charts, we have seen a significant upside rally from March, April to almost July, August. And we haven't seen any reasonable downward correction in between. And last 2-3 weeks, the market's consolidating, the market showing weakness from the highs of 20K mark is just a time correction rather than any significant price correction. So I'm expecting a limited downside from here and upside bounce from the lower levels. It may be around the 19,300, 350 levels, or slightly lower if it comes down, then around 19,100 levels.
Okay, what about your stock recommendations?
Yeah, stock recommendations, since the broader markets are looking very positive, they are diverging with the market's movement. We are observing a consistent decline in the Nifty, and broad market names like micro cap, mid cap, and small cap are surging up continuously without showing any reasonable downward correction in between. Even though smaller immediate supports like 10-day EMAs and 20-day EMAs in mid and small caps are holding on, and they are continuously moving up by taking that support. On the basis of that, I'm looking to give stock picks from the mid and small cap segment. My first pick is MRPL. If you look at the chart of the MRPL has a significant upside moment recently. What it has showed is the limited downward correction after the upside surge. It has moved into a range-bound action and currently placed at the resistance of around 87.50, which is a 10-line resistance area. A sustainable move above 87.50 is likely to take this stock to the immediate target of around 92, and I'm advising the placement of the stop loss around 85. So my next stock pick is KNR Construction. Chartically, KNR Construction was in a larger consolidation pattern. Recently, in the last couple of sessions, it has made an attempt to break above the 255 band, which was the high of the consolidation, and the overall chart pattern is looking positive. This upside breakout attempt is associated with the rise in the volume itself. So I'm expecting the further upside movement in this stock. One can buy this stock at current juncture, and I'm expecting the upside target of around 270 and 245 is going to be the stop loss. My third stock pick is RHIM. RHIM Magnesita India Limited. RHIM was moving in a larger consolidation band over the last months, in fact, and recently it had witnessed the consolidation, downward correction within a range moment. Today, a sharp up move as well as the sharp up move of this week has taken out this resistance band, currently trading around 715. The next immediate resistance, which is going to be the initial target, would be around 750, and one can place a stop loss of around 690.
We'll leave it there. Thanks very much for joining in. Good speaking with you. Actually, I wanted to ask you about GMM Pfaudler as well, but let's get a fundamental view. Prakash, of course, is with us. Prakash, thanks again for being here. GMM Pfaudler, seeing a big move today. The big overhang, which people have been talking about, is the promoter at some point, some large amount of stake will come to the market, right? And many have been waiting that, well, let's get that over with and then maybe the stock starts to perform. It's up 11.5%. Is there any news flow or what's the view, really?
So, good afternoon, Prashant. So, I'm not too aware of the news flow specifically, but what's probably getting the stock excited is the fact that it's taken almost 18 months for, the corporate action related to the promoters buying some stake at a rate which was not very favorable to the minority shareholders. And then the business probably has finally taken center stage. I think effectively the entire underlying industry is something, especially the pickup in pharma, is something which is very positive for some of these players, and they're just two large players in the listed space. The other player hasn't done any capacity expansion, whereas they've probably been much better. They've shown improvement in revenues, even in a phase where pharma and chemicals are not doing so well. So my sense is, they'll probably have that advantage, and they've introduced a lot of other products which are import substitutes. So which is something where, the margins also would probably start looking healthy. Now, what happens in terms of a block coming into the market, and I'm not too aware of that, but from a fundamental perspective, it started getting attention given these numbers that just came out. So I think it's more of that, and the market's actually very hungry in the mid-cap space to look for newer names. Yeah, I mean, and there is fatigue with the old names, so you always want to kind of latch onto something which seems a bit fresh. So.
Yeah.
What about defense? The defense earnings per se have not lived up to the hype, the kind of stock run-up that we've seen over the last couple of months. What have you made of the numbers, and is it time to lighten up any positions, any particular stock that you would like to highlight?
So, Rima, defense is played out brilliantly as a cycle. I mean, when nobody was wanting to look at shipping companies, at engineering companies, you had so much going for them. In fact, there was one time when all shipping companies put together were available for under 3,000 crores market cap, the larger ones, because it took some time for them to serially get listed one after the other. And then that pocket started getting a bit buzz given the huge order book that we built in. And I think thanks to the government's efforts at not only getting into this Atmanirbhar phase, but it's more of, Vishwa getting Nirbhar on Bharat, that's changed. And that has given a lot of acceleration to smaller businesses as well. So you look at defense is now probably about 35-40 companies in the listed space. It's not just the PSUs. I mean, there's a whole host of people who have kind of come in, especially in the recent listings. If you look at earnings, I think it was bound to happen. There's too much of expectation that's building up. Orders don't happen. It's a long sales cycle. The moment you start pitching, it takes you 18 months to actually get close to delivering. And the only companies that have a brilliant business model in that sense are HAL, some of the shipping companies which are executing orders which are very clearly visible for the next 6-7 years. So that's going to be coming in their favor. But the likes of BEL, which have to sing for their supper every quarter, are going to face a little bit of this yo-yos on expectations and results. So that's bound to happen. But look at new players which will start playing a very important role in defense, and Kalyani as a brand, Bharat Forge. Of course, they run their defense business under only one brand, and that's Kalyani. And their business model is so product driven and not just project driven, okay, which is a huge difference between the naval projects that some of the shipping companies, shipyard companies execute, or the HALs or the world. And there's one company that I keep on bringing. I don't know if you remember when the deal with the US majors was announced. There's a company called Midhani. And people
they're making some of the metal and the steel that's going into these aircraft.
I mean, that is, see, you can't make aircraft engines without the kind of expertise on metallurgy that you need. It's not just normal steel plates that you put and get. They're the only ones who actually have the expertise and the wherewithal to do it. And we discussed that stock at about 260. I don't even remember exactly, but I mean, you have these kind of opportunities which go unsung. You need to look at that. So there is some frontline froth, but then there is a huge opportunity which is building up.
Prakash, I have a follow-up question on Bharat Forge. By the way, we've got Cochin Shipyard numbers and they're not bad at all.
Yeah.
BEML has been bad and Mazgaon, was not exactly too robust, at least this quarter. Cochin Shipyard's numbers that just came out, they've done a profit of about 100 crores versus 42 crores last year. The revenues up about 8%. Margins have almost doubled from 7% to about 16%. So that's one good defense number. Let's just hear out the Baba Kalyani bite, because as I said, Prashant was in conversation. And then I'm going to come back and ask you about where that story is going, because of the management, that is Baba Kalyani, extremely optimistic. And they're saying that they want Bharat Forge to pretty much become the artillery house for the world. Take a look.
On the domestic side, there is a huge pipeline of orders which are under, let's say, the whole process. The process is quite complex. If you look at artillery guns, there is already a discussion going on for 307 guns of ATACs. There is another RFP for mounted guns, which is also of similar number. So we are looking at least in these two areas, the opportunity in the next, let's say, 1 year of getting orders is anywhere between 3,000 to 5,000 crores. I've always maintained many years ago that Bharat Forge will strive to become a artillery house on a global basis. We are targeting this year, our financial year, to get to somewhere around 1,200 crores. But that will be, say, almost like 800-900 crores of exports, and then the remaining domestic. And I think next year we would like to double this number.
Okay, so those are, of course, big expectations and big announcements they're coming in. Now, Prakash, some of the the naysayers will say that we've been waiting for this big moment to arrive for the Kalyani Group, right? And Bharat Forge, Mr. Baba Kalyani has been saying this for several years, and he explained that they're doing it all in-house. It's all indigenous. There's no tech transfer. They're not only manufacturing with someone else's technology, and maybe that's why it's been taking some time. The stock hasn't shot up as much as the 400% on HAL, right?
Yeah.
It's not been that kind of a massive monster move. But do you think that could happen, or is this the slow and steady? This is for investors who want to sort of play it for the long haul and expect more reasonable, earnings?
Yeah, good question. And that's precisely why brokerages are so divided on what to expect out of this. So, and some of them also went on to say it's valued at such a premium. Look at the history of how Bharat Forge as a company is evolved into a defense player. I mean, he's talking about 2,400 crores next year, in the next 18 months, which is significant in the overall scheme of things. So otherwise, they've plodded along as an auto castings supplier, and from automotive to railways. That took 4 or 5 years for them to really get up to speed. And they were the first to start defense collaboration with some of the Israeli companies, trying to get into that. The reason why the pace of growth for them or go-to-market is going to be better is only external factors, if you ask me. After the Ukraine war, there's a huge disruption in component supplies on the artillery side. That pocket of the Central Asian republics, all those ex-USSR nations, they are the largest suppliers of artillery. And whether Sweden or some of the other companies throw it. But that disruption is actually left so much of space for the likes of Bharat Forge to come in. So if they really have a good product and they can deliver effectively on that, they can actually live up to that aspiration. But it's going to be a while and it's going to be visible. So there's nothing wrong if you were to buy it. If something goes wrong, you'll get to know about it. It's not like a secret at what they're doing, and you'll only get to know about it after 12 months. So I think you need to give it some fair this year. And as a matter of disclosure, I do have exposure to this name right from the time it was an automotive player. So it's not just the defense thing. But I think it's important to realize the timing of the business is much more important at times to re-rate a stock than just the narrative itself.
Okay, Prakash, to stay on, need to slip into a very short break. When we return, we'll also invite our Alpha manager for the day, Aman Chauhan, fund manager at Abacus Asset Management. Welcome back. We're in conversation with Prakash Diwan, who's joined us here in the studio. Prakash, the top Nifty gainer today is HCL Tech, 3.5% higher. That big Verizon deal of $2.1 billion. What did you make of it? Are there any chinks in the armor? Is this the turnaround moment for HCL Tech?
Oh, for HCL Tech, of course it is. But whether you can extrapolate that for other companies happening and you know, the biggest of big companies coming into an order issuing mode, I don't know. But, you know, when I speak to some of the US fund friends who are working out there, the feeling I get is that the recession, so-called recession, is actually losing steam in terms of, except for a few pockets like commercial real estate and, you know, some consumption themes. But because of the destocking that everybody, the fear of recession actually had a larger impact on how things looked. Then the real thing. Now, if that were to change and a lot of money would go out of India, we'll start thinking, oh, why FIs are running out. But it's actually going to be good for us if the valuations get a bit softer, whereas the fundamentals don't change. So IT could probably be the first one to signal some sort of a change in that. These quarterly numbers don't give you that confidence. So if there is something like a follow-up or a stream of news flow around order booking,
so you would bet on US corporate confidence coming back?
Yes.
Resulting in spend, which will eventually bode well.
It could be with a lag, Rima, but definitely it's there. There's huge potential. Yeah.
Okay, I think we'll Prakash, leave it there. I will say goodbye. Thank you very much for joining us, and you know, see you next time you're here. Please do drop it.
We'll look forward to
it more frequent. All right. Well, thanks very much. Aman Chauhan is with us, a fund manager at Abacus Asset Management. He's joining us now to take some questions. Aman, good to have you with us here. Thank you very much for your time. You know. What fresh? You guys are stock pickers, right? I mean, very bottom up, not a very macro-ish kind of call, top down. So let me begin by asking you, what have you done recently in the last fortnight, maybe a little longer?
Not much. We have added more to some of the existing holdings. This based on how the corporate results have come in. So we would have added more to our financials. We would have added more towards cement. We would have added more towards some of the cap goods holdings that we have. Pharma, we had added in the past, so not in the recent time. So it's the last 15 days, these would be the three sectors that we would have added. Pharma would be, say, 2 months back. IT, still neutral, so haven't done anything new on the IT front as of now.
Hi, Aman. Good afternoon. Aman, what about the wires and cable space? You know, you all have one big winner in there, Polycab. What's the view, though, on this space? Do you think plenty of room for it to go, or do you think in the near term, I think you'll have exposure only via Polycab. Do you think for the near term, some kind of consolidation would be par for the course?
I feel this consumer durables, consumer companies, wire companies, even building material companies, they're all headed for good times because one, the festive season is starting. They didn't have that good a demand in the last 2 quarters, but closer to the Diwali season, festive season, and plus state elections in November, December, followed by central elections next year. So the next 12 months looks good because we have seen ahead of the election, there's a decent amount of money which comes into the economy. The rural market is buzzing, the rural demand picks up. And this can be something which is interesting for these sectors and these stocks. And that is the reason we are staying put. We own many companies in these sectors and continue to own them and like them from a 12-month perspective.
Aman, I know you don't talk about individual stocks, but I just wanted to get your thoughts in on Route Mobile because there was this very large deal, you know, with I think Opal Group, Proximus Opal Group, the Belgium-based company. How should an investor, a shareholder, look at this deal between Route Mobile and the fact that the promoters are partially exiting the company?
Yes, so as you mentioned, we don't discuss stock-specific things, but what is there in the public news is something that I can definitely tell you that the ownership has changed. Now the new owner is a global company. It's a Belgian government-backed entity with a decent presence in the US markets. Route predominantly was in the Asia-Pacific market. So it's a good, clear synergy between both the entities, and that should eventually benefit the merged entity. So clearly from a 2 to 3 year perspective, this is a growing market globally and Route is now better positions to you can say, capitalize on that. So right now, from being a regional to say Asia, Africa, and Middle East, now you are also getting access to European market as well as the US market. So then you become a global player. So the ambition is to be among the top 3 globally, and they have all the reasons to be there over the next 2 to 3 years.
So you're more bullish on Route Mobile post the deal?
You can say that, yeah.
Okay.
Okay, got that. Aman, hi, good afternoon. I was looking at the composition of the Abacus Diversified Alpha Fund, where you have a lot of the old economy stocks, basically industrial stocks. There's NTPC, there's Larsen, there's Cummins. Then you also have a Hindalco. You have a couple of the large banks there as well. So on the industrial side of the market, what's the thought? I mean, have you been happy with the sort of earnings that have been coming through? We were just having a discussion on defense as well, for that matter. Whether it's industrials or defense or engineering, what's the criteria and the filter that you're adopting as you're looking at perhaps additions to the portfolio from here on? Because the stocks have already gone up a lot.
Exactly. So pretty happy with the results, not happy with the P multiple that comes along with the results. So the challenge is where to deploy the fresh money, right? So these are good companies, still at decent valuation, but definitely you can't pay a very high multiple to them, even if they are growing pretty strongly in the near term. So outlook for these sectors, industrials, cap goods, and domestic manufacturing, defense, for the next few years is definitely positive. Now it's up to us as to what kind of valuation we would like to pay. So we are, but as you're aware, more of value conscious investors. So we would like to strike a balance somewhere between what growth and what P we give. So we focus much on PEG ratios. 1.5 PEG is what we are pretty comfortable at. So if the company is say growing at 30 times, I don't mind paying a 30, 40 P, but I definitely do mind paying a 70, 80 P. So keeping that criteria in mind, the names that you mentioned feature in the portfolio because these companies would broadly, you can say, meet the criteria that I just told you.
Okay, all right. Aman, what about pharma? That index has come back in a big way. Have you added positions out there? A couple of stocks that you'll have exposure to, I think, is Sun Pharma. But for your portfolio on the whole, have you increased the weightage?
Marginally. I'll not say much. In the last 3 months, we would have added a few bits of pharma exposure. In the last month or so, we haven't added much on the pharma bit. But whatever we have, we own it with a 2 to 3 year perspective. Pharma as a space is looking good. The high base of COVID is behind us, and the margin as well as pricing pressure in US market is also abating. So as things move ahead, from a good base, these companies can again start delivering consistent mid-teens to high-teens kind of earnings growth, and that should eventually get reflected in the stock price also. So that's broadly what the pharma view for us is.
Is that kind of going big? Are you doing it for growth, Aman? I mean, there's pharma into pharma, or is a little bit of protection? Although pharma also on the downside has not offered that much protection, but you're not a team which is satisfied by mid-teens kind of growth. You look for a high growth. So just wondering.
So the whole portfolio can't be high growth. So this also brings in stability. We are, you can say, we have very few of consumer names. We have very few of high P stocks, which are very stable stocks. They offer less return, but they're pretty stable. So in a way, this also gives us stability on the portfolio front. So we compensate that, the less of consumer exposure with more of pharma or IT exposure. So that is the balancing that we look forward.
Oh, okay, that's interesting. In fact, I was just noticing that I think in your top holdings, I could only spot maybe a Radico or a Raymond, not too many consumer stocks, neither discretionary nor staple. So that's entirely a valuations issue, is it?
Entirely valuation issue.
Okay, got that. So talk a little more about technology. I mean, you mentioned broad thoughts on Root, but for instance, HCL Tech is a big holding in a couple of your portfolios as well. And there's been this raging debate about what lies ahead and whether we'll go back to the pre-COVID normal and whether the growth was just over-exaggerated, over-anticipated during COVID times. So where do you stand in that debate? And when you talk about holding some of these large cap tech stocks in the portfolio, what is the earnings run rate that you'd be happy with, that you can pencil in at current valuations?
So we feel this is a year which is going to be a reset year for IT companies because what happened is during COVID time, there was a mad rush to go digital. There was a mad rush to spend and be ahead of each other on the digital front, and that is now awaiting. Lots of startups, lots of .com companies, IT budgets have also come under scanner because the easy money which was flowing through during COVID times through private equity deals for most of the startups have now stopped. So they have to be rational in their spending, and that has impacted the near-term earnings growth for the Indian IT companies. But as a business case, these companies have proven during COVID times that it is not just a cost arbitrage, but they can deliver globally, seamlessly. During the whole lockdown, there was not a single day when we would have discussed that this banking system is down, my online payment has not gone through, my online shopping has not gone through, something is not working. So digitally sitting in India, whether working from home or office, Indian IT companies are delivered, right? So that is something which is a statement, and this is going to stay for the next multi-decades now. So this is the year where the reset, because from a high base where people were desperate to spend, and they were spending big time and were okay to give even higher bidding rates, now they're getting more rational. Once that sets in this year, then from a normal base, I think high single digit to a you can say low teen for a large cap company in IT should be the norm. That should be the CAGR growth rate for the next few years. For a mid cap IT company, it's anywhere going to be say high double digits to even 20-25% growth in some companies, and that's where our focus is. So in IT also, we prefer looking at a mid cap than a large cap because the growth rate definitely is going to be much higher in the mid cap space.
Aman, thank you very much for joining in. Need to slip into a very short break, but with the news that the markets are once again down more than 100 points. When we started the show at 2:30, the Nifty was down about 50-60 points, but the cut has gotten deeper and we're at the day's low once again. Nifty below 19,430. Get into a break. We'll come back and get you a check on what dealing rooms are saying. In our segment D3 Chatter, we get you a few BTST calls too.
Welcome back. You're with us on Closing Bell, and let's move on and talk about Zydus Life Sciences, which reported a good set of numbers for the first quarter. Growth was led by strong U.S. sales. Revenue saw a 30% increase on a year-on-year basis. EBITDA expanded 81% over last year. To discuss this and more, Ekta caught up with Shraval Patel, the MD of the company. She started off by asking him about the U.S. business. Take a look.
So I think the US business has seen an overall great quarter. Actually, Revlimid has been also in the previous quarters also. So on a quarter-to-quarter basis, there has not been any major significant increase on only Revlimid. But it's just because of the portfolio of products that we were able to launch, many one-time buy opportunities, with some pricing in the US being relatively stable. And better product mix, I think, has led to a much better performance than normally expected.
Okay, all right. So that's the reason for the improvement that you've seen in the US business. What is the quarterly run rate that we can expect for the US sales going forward now, considering that you are at this level of around $295 million? Are we going to assume this is a base going forward?
So I think on the US business front, we do strongly believe that over this coming financial year, we should have a good double-digit growth to the US market, assuming that we will still have competition to one of our differentiated products. So in spite of that, we will see a good double-digit growth to the US business.
Okay, good double-digit growth. Is the Pfizer injectable plant getting damaged in the US maybe an opportunity for you all?
So I think it's too early to say. The only media reports say that there was most to do with the warehousing and other areas. But so I think I would have no comments on to know whether there hasn't been any impact because of supplies related to this.
Okay. Now coming to India, India in fact has grown just shy of 10% this time round. Adjusted for NLEM, what was the growth and what are you guiding for in FY24?
So I think the India business has done very well for us. We have adjusted to NLEM, have had a growth of 12%, which is much better than the market growths. And if you take the journey over the last 3 to 4 quarters, we have consistently delivered market growths for our India formulations business, which is a large formulations business for us. And more importantly, I think going forward also, we are seeing good trajectory to this. This is helped by our proprietary and differentiated molecules that we have been able to launch in India, and they're becoming more sizable and relevant for us. And going forward also, I think what is very happy to note is this quarter we had almost a 6% volume growth. So it was not a price-led growth, but sheer improvement in volumes that has also led to this growth.
Okay. And what about margins? Because the US has done well. Your margins have come in at these elevated levels of around 29%. Tell us what is a range which is sustainable for you when it comes to your operating margins?
So yes, we have had a significant improvement in margins, and going forward also we believe that from our earlier guidance we would see 150 to 200 basis points improvement in our margins in the coming financial year.
Okay, so what is a sustainable level that we can expect?
So 24 plus is something that is sustainable.
Okay. Your NCE subsidiary, last quarter the company had made an impairment of around 600 odd crores in Sentinel Therapeutics. What was the performance like this quarter?
So now the Sentinel is working mostly on ultra rare orphan diseases. It has launched one product which is Nulibry, and we hope that in the coming year we have 2 more important launches that come up in the rare diseases side. So the scale up is still very early on. I think we need another next 2 to 3 years for this business to scale up from its earlier levels after we stopped selling one of the drugs in the last year after genericization.
Well, the markets actually have moved to the low point of the day. So now we're trading around that 19,425, and the Nifty Bank actually is the one that's breaking down. So that's more below the 44,200 odd marker. As of now, it appears it's not going to be a good close. And if we have to bounce from here, it'll be important because otherwise we're going to be ending closer to the low point of the day. But a good time to get a quick check into D Street chatter. Nimish joins us. Nimish, what are you picking up in terms of the Wall Street action?
Well, Nigel, not only for today, but for this week, the markets have been in a very narrow range, right? We've been trading between 19,400 and 19,600, largely in that range. So the sense is, either way, you have to break below 19,200 for a big fall down, or above 19,800 for a big rally to carry on. So that's a broader technical range, so to speak. In terms of flows, again, a mixed job of trade, but I guess while the screen may not suggest, but there is buying interest in the technology names. The large cap technology stocks are well bid again in today's trade. So this week, the trend has been selling banks and buying IT. That's been the broad, from a flow point of view. I guess the other sector which has done well is the PSUs. Not only the PSU banks, which are actually outperforming the large private banks today, but largely the PSU stocks are well bid, and there is a lot of action as well from the HNIs as well in the PSU stocks. So that's again a sector which has really outperformed. And the broader market, even in this range-bound trade for the whole week, the broader markets have relatively outperformed. There are a lot of stocks which have done well, largely on the back of good numbers or chased by momentum from HNI. So the broader market momentum continues, but it's like in the Nifty and the Bank Nifty seems to be in a very tight range. You need to break on the either side for a big decisive move.
Well, that's right, Nimesh. What about the PSUs? You had our Prime Minister Narendra Modi. He said it. There is value out there, and the market heard. The nation has heard it. So,
absolutely.
But what about individual stocks? What do you pick up?
So, Nigel, the big theme has been the large block deal. So I'll continue with that theme as well. Even in today's day, there were multiple blocks. The first was Suven Pharma. There was a 2% equity which got changed hands in Suven Pharma today, and I believe a leading FI investor who's an existing holder in the stock was a buyer in today's block. So disclosures could be important in Suven Pharma today. The second stock is SGS Enterprises. Very small stock, not much been talked about, been consolidating a very narrow range. I believe even in SGS Enterprises, there is an indication of a very large block deal coming very soon. So that's something to track there. The third stock is PNB. I spoke about PSU banks outperforming the private banks. PNB stands out largely on back of very strong buy flows at a leading FI. So looks like some bit of buying traction is back across PSU stocks, and PNB leads the chart there. And the last stock is Radiant Cash. This is again, there was a large block today. Nearly 5% equity has changed hands. In terms of sellers, looks like a private equity investor was a seller, and there were multiple buyers, including a hedge fund. So this week, if you look at, this is a second cash management company where there was a large PE sold. So again, the trend of PE selling and promoter selling continues.
Actually, not just PE and promoters, the trend of selling is continuing in the market today itself. Nimesh, thanks so much for that. Take a look at the screen, because we're looking quite weak now. 19,416, 17 on the index. A sharp second leg of the sell down that's happened now. And we're making fresh lows, not for the day, but for the week. And that's the point we've been making, that is why this is not looking like a very good session at all. The market is now at the lowest levels since the 3rd of October. We've undone all the work of the last about 7 or 8 trading sessions, and the weakness on the Bank Nifty is quite severe now, almost 400 points down, 44,150. So, yep, it is bears in control as we head into the weekend. That is the screen for you. Nagraj is back with us. Nagraj, tell us, what do you make of this fresh bout of selling, and what would the advice be now going into the weekend?
Yes, selling seems to have intensified, but I believe there is a support for the market. If you talk about the Nifty, 19,300 is an immediate support, and I'm expecting if this support fails to hold, Nifty to bounce back from the lower levels of around 19,100 to 19,000 level. So correction was due according to a last 3-4 months rally. This is what exactly happening in Bank Nifty as well. After the RBI announcement, the Bank Nifty has a bit weakened, and I'm expecting further downside Bank Nifty, but not a sharp downside reversal as of now. From here, Bank Nifty is likely to find the next support of around 43,800 to 43,900 levels.
Okay, thank you very much for that. Let's take stock of some earnings which we're anticipating. Nigel, JSPL, what's the street looking at?
Well, the street is anticipating a good set of numbers. Actually, just take a look at the stock. It's outperforming all through the trading session. There's big open interest built up as well. Let's run you through the expectations. On the top line, we're expecting a downtick of close to around 2%. On a year-on-year basis, it'll be down by close to around 35% on the EBITDA front, which would mean margins will compress and the profitability will be much lower. But for JSPL, the key factors at play is that the volume growth will be in excess of around 10%. What weighs on the top line, the reason we'll see a flattish to a degrowth out there is because realizations are sharply lower on a year-on-year basis. The positive, though, is the Q1 FY24 EBITDA number. That's likely to be a little bit higher or flattish in comparison to Q4 FY23, which will be much better than any of its peers. Why is that? They'll get the benefit of lower coal prices. Second factor is their iron ore cost as well will be lower. And the third factor is in Q4 FY23, you had a one-off out there, which will not be there this time around. So that's why on a quarter-to-quarter, so it'll look actually the best among the steel names. What do we watch out for? Management guidance on volumes, the export volumes in particular, the capex as well as their debt plans. Remember, they're looking at ramping up capacity from around 9 million tons to around 15 million tons. So how is that progressing is going to be very, very important. But for the time being, the street is sensing that we're likely to see a bit of a positive surprise going by the stock price movement.
Okay, thank you very much for that. And Surbhi is also waiting by to tell us what she's expecting from Sun TV this time. Surbhi?
Thanks so much for that. So, for Q1, the revenues are expected to be up nearly 6% on a year-on-year basis. And this is largely going to be driven by the IPL revenue. The IPL revenues are expected to be in the range of 450 crores, which was nearly 200 to 240 crores same time last year. But on the other hand, ad revenues are expected to be muted, which we have seen in Z as well, because the FMCG space is muted for the first half, which is why it is going to have an impact on the ad revenue. And on the subscription revenues, the expectations are that the revenue growth will be in close to 10% on a year-on-year basis. Margins are expected to be stable at around 63%. PAT is going to be in the 600 crore range versus the 494 crores that we've seen same time last year. And again, this is largely going to be led by the IPL revenue. It will be also important to watch where the position is on when it comes to market share and the IPL revenue. So two key things that I'll be watching for Sun TV.
Thank you very much for that. And here's a quick programming note. Our weekend special Editors Roundtable is coming up today at 4:30 p.m. We get you a sneak preview of what are the big themes that we're tackling. As another week of close to $1 billion of block deals in which promoters and strategic investors have sold large stake. Nimesh will get us the details.
Recent IPOs on D Street were off color in the first quarter of 24. Nigel will get us the details on this.
This week, we saw signs of a turnaround and improvement in platform companies, the new age tech companies. What went right for these companies? Sonia will get us a quick analysis.
Outright deflation in China was confirmed this week. Can China avoid the Japanification of itself? Prashant takes a look, so don't forget to tune in. We go live at 4:30 p.m. Editors Roundtable right here on CNBC-TV18.
Welcome back. Well, as we speak, the markets, at least we've defended the lower levels, and intraday we've recovered 25 points or thereabouts from the day's low. So let's see how this goes. 9 minutes to the close. Mayuresh Joshi joins us to help us out with some stock analysis. Hi, Mayuresh. Good afternoon. Thanks so much for speaking to us. Mayuresh, what are you making of the move that we're seeing in Hindustan Copper? Have you heard anything? I mean, there's no brokerage that really covers it. Valuations is not an argument because they do a couple of rupees of EPS every quarter. But the stock has been moving from strength to strength. Your view?
Afternoon, Nigel. I think two things that have transpired. After Hindalco posted its numbers, the copper business for Hindalco has stood out very, very well. So if you probably look at both the rod sales and the core copper earnings in terms of value-added products, they have actually shown huge signs of stability and in fact some signs of improvement going forward as well, going by what the management probably believes. That's a very small component of overall Hindalco's business. But for Hincopper, I think that's a majority part of their business. And if the expectations largely are that the copper part of the business for Hindalco has done exceptionally well, I think Hindustan Copper, where a majority of earnings comes from copper value-add products as well, including rods, I think that should hold up earnings. And with inventory levels expected to be at dismal levels, both domestically and at an international scale, any bounce back which probably comes to in the second half can have an incremental addition. So I think that's what probably we are sensing in terms of what Hindustan Copper can probably do.
Okay, got that. Mayuresh, hi, good afternoon. I wonder if Z is under your coverage, and if it is, then well, finally we have a breakthrough in the form of the NCLT clearance on the merger. What thoughts on the stock from here on?
So I think unfortunately, Surabhi, afternoon to you, not on our coverage list. But I think the news that has probably happened is obviously going to be value accretive because in spite of the promoter transfer or what happens to the promoter still being in limbo, I think a large part of the consensus on the street is that since the NCLT approval has come through, a lot of synergy will now start getting built into both in terms of revenues and cost. So I think that's what the street sense is, no official coverage.
Okay. Do you look at Apollo Tyres? The stock has slipped some more, now down nearly 9%. It's rallied 70% plus in the last 1 year. And the operational performance in Europe was a bit underwhelming. But would you like Apollo Tyres, or are there any other tyre stocks under your radar?
Afternoon, Rima. I think tyre stocks did exceptionally well. Apollo, JK Tyres ran up quite significantly in the past few weeks. And obviously, I think the tailwinds in terms of the new launches that were expected to take place, the kind of bookings that we've probably seen, Hero, Bajaj, and their new launches, the replacement market obviously doing very, very well for these players as well. I think that had aided a lot of growth in terms of price. The numbers, I think, and expectations from the market, I think it was a clear amount of mismatch. As you rightly pointed out, I think a below par performance as far as Europe is concerned. But to a large extent, I think two things that the street will probably look out for, specifically from tyre earnings. One, obviously, in terms of the OEM players, where demand is expected to remain strong.
Okay, I think we lost the line there with Mayuresh. We'll just try and have that. Okay, I think he's back. Mayuresh, go on. Sorry, we lost the line there.
Right. So I think the aspect in terms of how demand holds up, both in terms of the replacement and the OEM market, which it should, and how raw material prices are expected to move. You've probably seen crude move up a tad bit in the last few weeks. So crude derivatives obviously are going to move northwards to a certain extent. And therefore, does that have a significant amount of demand contraction is something to be seen. The dumping that was probably happening in the replacement market to a large degree has been constrained. But numbers were a little bit off the radar in terms of a mismatch that they probably reported. But if they fall more and if they make a proper pace at lower levels, Apollo JK Tyre would definitely be on our watch list.
Okay, Mayuresh, and finally, as we are all set to wind down for the day and the week, leave us with the any interesting stock that perhaps was top of mind for you in this result season, whether great earnings or some important triggers. Leave us with a good pick that you have in mind.
So we like Kirloskar Oil Engines a lot. I think that's something that we continue holding in our portfolios. The stock delivered a very good set of numbers yesterday. Obviously, a leadership position in the power generator space. and it suffices for most power outputs, right from 2 MVA to almost 1200 MVA as well. The export markets and domestic markets have held very well for Kirloskar oil engines this time round. In fact, the management has put out a statement, the CPCB emission norms, they're fully compliant across their product range, and the only Indian company which is probably compliant, which means the volume growth should be good, even going into the second half as we approach. EBITDA margin, standalone, consolidated basis, both year-on-year or quarter-on-quarter, was a clear beat. And with the kind of numbers that one can expect in terms of top line and earnings growth, with a very good EPS and RS rating at market mid, we believe that there is much more potential for KOEL. So I think Kirloskar oil engine is something that has stood out for us and which stands in our portfolios as a scale.
Mayuresh, thank you very much for joining in. Enjoy the rest of the day and the weekend. It's going to be a disappointing close for the markets. We're down 0.5% on the Nifty and the Sensex. But, you know, this is the week where in the beginning we were trying to see whether we can climb above our 20-day moving average, right? The hope was that markets will break the 20-day moving average and inch higher. But now we've put in a gap of nearly 200 points from that 20-day moving average. And there was a second leg of selling which came in the last 30 minutes. So the Nifty is down more than 100 points for the day, a cut of 0.5%. For the week, the Nifty is down close to about 0.5%, a similar cut on the Sensex, but the mid-caps managed to close the week, at least with some gains. So week to date, the mid-cap index is currently up close to about 0.5%. The advanced decline ratio for the day firmly in favor of the stocks under pressure. The big losers, IndusInd Bank is your top Nifty drag today. You've got cuts coming through in NTPC, Divi's Laboratory, UPL, SBI Life, Asian Paints, Sun Pharma. So across the board, you are seeing stocks in various sectors. The gainers list includes HCL Tech, and that's the top Nifty gainer. And outside of that, just Power Grid and Titan. These are the only two stocks with gains of more than 1% in the frontline bag.
Well, mid-caps, the index actually succumbed to pressure. By the end of it, even the mid-cap index was down about 0.5%. The advanced decline ratio is actually very negative, just about 1,000 stocks advancing and over 1,700, almost 1,800 declining. So weekday for the mid-caps can't take away from that. If I talk about the areas where the pressure was most felt, or some of the big declining stocks, look at something like an Ashoka Buildcon, down quite a bit. We were discussing Z right now, 3-4% down on Z as well. Then you had some result reactions which the street didn't quite like. Apollo Tyres stands out as a sore point there, 8% down on that stock. Pull up some of the other result reactions. InfoEdge, Naukri's numbers didn't really help matters. Mazgaon Dog down about 3%. There is BEML, which came out with a loss. So, you know, some of the earnings today have not really inspired too much confidence. However, on the upside, you do have some interesting names. And GMM Pfaudler was definitely one of them. That's a very solid result reaction with a 10% gain. Some of the stocks that get added to the MSCI indices like REC managed to retain some gains, about 3.5% there.